A lot of people think the only way to make money from stocks is to buy low and sell high. And let's be honest, that's what we're all taught, right? But that's just one piece of a vast puzzle of the stock investment universe that we have to uncover. And I'm here to break that down for you today. There are actually 5 ways that stock investors can make money with stocks. And it's not just by buying low and selling high. Let's get into it. Hi, my name is Alex. If you're new here, and what we do here is decode the business behind the stock and look at the investing principles that you need to be a successful investor. Here are the 5 ways that stock investors make money. The first is, well, the most obvious, is capital gains. When you buy a stock and it rises in price, that increases the market value of however many shares you own. So, say you buy one share for $10 and then it grows in value to $20, you have a $10 gain. And so you can make money by selling your stock and cashing out. Number two is dividends. Dividends are a portion of the profit that companies make, and they pay it out to shareholders, usually directly as cash. Sometimes companies give dividends in the form of additional stock, but usually you'll see the cash dividend. Now, these can be quarterly payouts, they can be semi annual payouts. European companies typically pay dividends according to how their profits are doing that year, whereas companies in the United States typically pay out a steady dividend or a steadily rising dividend over time. The third way that investors make money is through buyouts or tender offers. This is when another company comes in and decides to buy out the company that you own shares in. Sometimes you'll get paid out in cash. Sometimes you'll get paid out in stock of the company that's buying the company that you own shares in. Or maybe it's a combination of both. It just depends on the deal. An example of this is when luxury conglomerate Louis Vuitton Moet Hennessy bought Tiffany and Company, the jeweler, back in 2020. They made an offer. Tiffany and Company was a publicly traded stock independently, and then LVMH decided to buy them out, and they paid cash to the shareholders of Tiffany and Company. Another example is when Dunkin' Brands, the coffee and donut company, actually got bought out by a private equity group. And this is the kind of thing that happens in the stock market all the time. So if you own shares in a company or a number of companies for any length of time in the market, this is probably going to happen to you at some point. Hey, if you're enjoying this episode, I would really love it if you just show me some love, tap that like button. I really appreciate it. Thank you so much. Now, one thing that's not so obvious about this way of making money is you may be asking yourself the question, like, Alex, okay, I get it, but why is this different from capital gains? I'm just making money from the stock going up, right? Well, yes and no. It's similar to capital gains, but there's usually a premium that you get because the company's being taken over 100%. There's usually a premium on that transaction because they're getting the entire thing, they're getting control. It's basically a control premium. Compare that to, say, you and I, as regular retail investors in the market, we're going to pay a lower price because me buying 50 shares of whatever company does not mean I'm going to have control over it. But if you want complete control over a company, you have to pay a little bit of extra money. The fourth way that investors make money is through something called spin-offs. Sometimes large companies, especially large diversified companies, have segments of their business that just don't really fit with the main line of business anymore. So, one option is to spin off that company, which is essentially creating a brand new publicly traded company separate from the primary company. This is pretty cool because as a shareholder, you now own shares of both the original parent company and then the newly formed independent child company. Sometimes two companies are worth more separate than together because they have their own independent management teams, they can make their own decisions, and so you can get greater value through spin-offs sometimes. One example of a spin-off is the conglomerate IAC, which spun off a company called Vimeo, which you may have heard of. Vimeo is basically a video software solution for businesses, and it was part of this big conglomerate, but IAC decided to spin it off. So now it's its own publicly traded company. It has its own ticker symbol. It's completely independent. Now, the fifth way that shareholders can make money is through something called a split off. Now, a split off is very similar to the fourth method, which is a spin off, but it's a little bit different. Instead of a spinoff where you're just given shares in the new company when it goes public, with a split off, it's the same thing, except you have to decide how many of your shares you want to trade in the parent company for shares in the child company. Sometimes it's a 1-to-1 ratio. For example, when General Electric had a split off of Synchrony Financial, that was a 1-to-1 ratio. You could trade one of your GE shares in for one share of Synchrony Financial. Another example is when McDonald's split off its interest in Chipotle all the way back in 2006. And in this deal, for every $1 of McDonald's shares that you decided to trade in, you got $1.11 worth of Chipotle stock. Now we can see how this is advantageous, especially because both spin-offs and split-offs are typically tax-free events. So that means you don't have to pay any taxes to do this kind of conversion. And in this case with Chipotle, we can see in retrospect how this could have been a very good decision for you as an investor. If you took some of your McDonald's shares and traded them in for Chipotle shares, you would have done very well if you held them to today. You can see that there's no one way to make money in the stock market. There are actually many different ways. And I hope that you've learned a lot from this video. But there's actually one of these 5 ways that I think has a little bit more nuance to it than what I've described here. And I've went ahead and made another video that you can check out right here that will describe exactly how this way accelerates your returns. So go ahead and check that out, and I'll see you in the next one.